Welcome to the Deep Dive, where we unpack the financial developments shaping your world. We aim to bring you those essential insights, without the usual information overload.
That's the goal.
Yeah.
Cut through the noise.
Exactly. And today, we're really zeroing in on a groundbreaking move.
Yeah.
Something that could fundamentally redefine how traditional investors access the vibrant world of crypto.
Specifically the yield part, right?
Precisely. Especially when it comes to earning yield. Imagine, for a moment, gaining exposure to Solana staking rewards.
Okay.
Not through complex blockchain interactions, setting up wallets, managing keys, none of that, but through something as straightforward as familiar as an exchange-traded fund, an ETF.
It's definitely an appealing concept for many. Easier access.
It's a fascinating prospect, wouldn't you agree? We're diving deep into VanEck's landmark filing for what poised to be the first ever U.S. ETF backed exclusively by a liquid staking token.
And that token is JitoSOL.
JitoSOL, exactly, representing staked Solana. Now, you've entrusted us with a fantastic stack of sources, really insightful articles from Cointelegraph, Crypto Briefing, A-Invest, CoinDesk, Decrypt, many more.
Good stuff there. Lots to unpack.
Totally. Our mission today is to sift through all this, extract the most critical nuggets, connect those dots for you, and hopefully deliver those aha moments that make you feel truly well-informed.
Get to the heart of it.
Right. Because this isn't just about another crypto product launch. It feels bigger. It represents maybe a significant bridge being built between traditional finance, Wall Street, and decentralized innovation.
TradFi meets DeFi yield in a regulated wrapper.
And that comes loaded with some really intriguing regulatory implications, stuff we absolutely need to explore thoroughly. So let's get right into it.
Let's do it.
Okay, so the headline news, the thing reverberating across both crypto and traditional finance sectors, is VanEck's recent S1 registration, filed with the SEC.
The big one.
Yeah. They filed for a JitoSOL ETF. And like we said, this isn't just another crypto ETF. We've seen Bitcoin, we've seen Ether.
Right. The spot ETFs paved the way.
But this one's making waves because it's positioned as the first ever U.S. ETF backed exclusively by a liquid staking token. That LST acronym is key here.
Liquid staking token, yep. And specifically JitoSOL.
JitoSOL, representing staked Solana. So we're talking about a product that seems meticulously engineered to funnel Solana staking yields.
Actual rewards from securing the network.
Exactly. Funnel those rewards directly into the familiar, regulated channels of traditional investment platforms, your brokerage account, basically.
Which really marks a significant moment, doesn't it? It's a step beyond just price exposure.
It feels like a major step, but maybe you can elaborate first. What is JitoSOL fundamentally?
Absolutely. So what's truly fascinating here, and many listeners familiar with crypto will know this, is understanding the core asset, JitoSOL.
Right.
When you stake directly on a proof-of-stake network like Solana, you lock up your SOL tokens. That's the basic mechanism.
You commit them to help run the network.
Precisely. And while those tokens are busy generating rewards for supporting network security, they become illiquid, stuck.
You can't just sell them tomorrow if you want to.
Not easily. You can't trade them. You can't use them in other DeFi protocols without first unstaking them. And that unstaking process, it often involves a waiting period, sometimes days.
Which is a drawback if you need flexibility.
A major drawback for many. And this is exactly where a liquid staking token, or LST, like JitoSOL, comes into play. It's really quite an elegant solution.
Okay, so how does it solve that lockup problem?
Well, JitoSOL is essentially a receipt token. Think of it like that. When you stake your SOL through the Jito protocol, you receive JitoSOL back in return.
One for one, or?
It represents your original staked SOL plus all the staking rewards that accrue over time. So its value relative to SOL should increase gradually.
So the rewards are baked into the token itself.
Exactly. And crucially, JitoSOL remains liquid. That's the L in LST. It can be traded on decentralized exchanges, sometimes centralized ones. It can be used as collateral in DeFi lending, or just held in your wallet like any other token.
All while the underlying SOL is still technically staked and earning rewards.
Correct. All while the underlying SOL continues to accrue those staking rewards. So you're not sacrificing liquidity to earn that yield.
That's a powerful combination, liquidity and yield.
It really is. So this proposed ETF isn't just a vehicle for price exposure to Solana, though it offers that too. It's explicitly designed to capture and then pass on the yield generated from Solana's proof-of-stake mechanism.
And that yield-bearing characteristic, as you said, that's a significant evolution from the spot Bitcoin and Ether ETFs we saw approved earlier.
A huge evolution. It really changes the game, potentially offering a whole new dimension of return for traditional investors dipping their toes into crypto assets.
That yield component is absolutely what makes this so compelling for a traditional investor, isn't it? It's a different proposition.
Totally different. It's not just holding a digital rock hoping it goes up. It's holding an asset that produces something that generates income.
Right, like a dividend stock almost, but from a blockchain network.
Exactly. And the primary undeniable benefit here for that traditional investor is providing regulated access to these Solana staking yields without demanding that they navigate all the inherent complexities of actually managing staking infrastructure themselves.
Let's break down those complexities. What are we talking about?
Well, think about it. If you wanted to stake SOL directly, especially at scale, you might consider setting up your own validator node. That requires technical expertise, hardware.
Significant commitment.
Huge commitment. You need to ensure near-perfect uptime if your node goes offline, you stop earning rewards, and could even face penalties. You need robust security protocols to prevent hacks.
And then there's the scary part, slashing.
Yes, perhaps the most daunting for many, understanding and mitigating slashing risks. For those less familiar, slashing is basically a penalty mechanism.
How does it work?
If a validator misbehaves, like trying to validate fraudulent transactions or even just having extended downtime, a portion of their staked SOL and potentially their delegator's SOL can be forfeited, burned, gone.
Ouch. So there are real risks beyond just the price going down.
Absolutely. These technical and operational demands, the slashing risk, they've historically been a really significant barrier keeping mainstream investors away from direct staking.
Makes sense. It sounds like a full-time job almost.
It can be, but with a JitoSOL ETF, potentially all those complexities just get abstracted away. They vanish from the investor's perspective.
So how does the ETF handle it then?
VanEck, or the ETF issuer, would handle the complexities. They or their partners would manage the staking, deal with validators, handle the security, manage the risks. The investor simply buys shares of the ETF.
Through the regular broker.
Exactly. Through familiar brokerage interfaces, just as easily as they might buy shares in Apple or an S&P 500 ETF or a gold ETF.
So it completely removes that technical headache.
Completely. And it removes the direct custody burden too, which is another big hurdle for many. With an ETF, the underlying JitoSOL, and by extension the staked SOL, is held by a qualified custodian, managed professionally.
You don't have to worry about losing your private keys.
Precisely. It's a professionalized, institutional-grade wrapper around what is fundamentally a decentralized yield mechanism.
Okay, so let's break that down further. What does this really mean for you, the potential investor, sitting there, looking at your portfolio options, maybe curious about crypto yields?
Well, first and foremost, it means simplified, streamlined access to what could be a pretty attractive component of the crypto ecosystem, staking yields.
You bypass all that technical stuff we just talked about.
Completely. You sidestep the need to understand the nuances of blockchain wallets, different staking protocols, how to choose and delegate to a validator, all of that.
And the risk profile changes too, right?
Significantly. It mitigates that individual custody risk we mentioned. The assets are held and managed by a regulated entity, VanEck in this case, not you personally securing keys. That's huge for peace of mind for many investors.
So it fundamentally lowers the barrier to entry. Massively.
Absolutely. It transforms something that used to be quite niche, really technically demanding, into a potentially much more approachable, accessible investment opportunity for a broader audience.
And we've already seen a glimpse of the moment's potential enthusiasm for this, haven't we?
We have. The initial market reaction was quite telling. Following the announcement of the S1 filing, various sources, TradingView, Crypto Briefing, A-Investing, they all quickly reported a noticeable jump in JitoSOL's price.
How much was it?
Around 6%, approximately. An immediate reaction.
Wow. So not just theoretical speculation.
No, it's a concrete demonstration of immediate market interest. It shows validation for this type of product structure. There seems to be a real appetite out there for regulated access to staking yield.
Just think about how that immediately widens the net, right? For who can actually participate in these staking returns.
Exactly. It potentially moves it beyond just the crypto native audience, the DeFi degens, into much broader traditional investment circles, your average brokerage account holder.
It really could represent a significant paradigm shift in how yield generation from digital assets is perceived and, crucially, accessed by the mainstream market.
It feels like a potential inflection point.
Now, this is where the plot really thickens, I think. Because As we know, this filing isn't just happening randomly. It's not in a vacuum.
No, the timing and context are critical.
It seems to be riding on a very significant and maybe somewhat surprising wave of evolving regulatory clarity, especially from the SEC.
Yeah, the SEC, which, let's be honest, has historically maintained a notoriously cautious, sometimes perceived as adversarial stance towards the crypto industry.
Right, so this shift, whatever it is, seems absolutely critical to VanEck even attempted this audacious move.
You're absolutely spot on. The SEC's apparent evolving position, or at least its recent interpretations, they form a critical bedrock, a foundation that enables this entire filing.
What evidence do we have of this evolving stance?
Well, recent regulatory signals, and we've seen this discussed in sources like a Cointelegraph and A-Invest, they suggest a more nuanced interpretation is taking hold, specifically regarding liquid staking.
Okay.
The signals suggest that the liquid staking activities, or perhaps more precisely, the receipt tokens generated from them, like JitoSOL,
Yes.
are not necessarily being classified as securities themselves by the SEC, or at least there's a path to argue they aren't. And this is a really crucial distinction. We need to unpack this a bit.
Please do, because the is it a security question hangs over everything in crypto.
It really does. So the traditional test the SEC uses is the Howey test, right, from a 1946 Supreme Court case.
Investment of money, common enterprise, expectation of profits from the efforts of others, the 4 prongs.
Exactly. For a long time, the big concern in the industry was that staking itself, or maybe the LST representing it, might tick all those boxes and thus be deemed a security.
Especially the efforts of others part, maybe. Relying on the protocol or the LST provider.
That was a key area of debate. However, the SEC now appears to be leaning towards, or at least signaling openness to, viewing these receipt tokens like JitoSOL differently.
How so?
Not as the investment contract itself, but more as simple evidence of ownership. Essentially, a property right.
A claim ticket, almost.
Kind of. A property right to an underlying staked asset, the SOL, and it's naturally accruing rewards from the network protocol's operation. It's maybe analogous to holding a warehouse receipt for grain or certificate of deposit.
Okay, I see the analogy.
The argument is that the yield primarily comes from the network's inherent operation, the proof-of-stake consensus mechanism itself, not necessarily from the active, ongoing managerial efforts of the LST issuer, like Jito or Lido, in a way that would satisfy that crucial 4th prong of Howey.
So the LST provider facilitates, but doesn't solely generate the profit through their efforts. The network does.
That's the core of the argument, yes. It's a subtle legal interpretation, but it's incredibly powerful. It could genuinely unlock a whole wave of regulated crypto yield products.
Because without that specific view from the regulator.
Without that view, the entire concept of a U.S. liquid staking ETF would likely be dead on arrival, a non-starter.
Wow. Okay, so if I'm getting this right, it's not necessarily the process of earning the staking rewards that the SEC might view as a security offering in this context,
Right.
but rather the token representing that staked value and earned yield is perhaps being seen more like a property right. That's subtle, but yeah, profoundly impactful for the regulator. Makes all the difference.
Precisely. That potential shift in interpretation is absolutely pivotal. And if we then connect this development to the bigger picture,
Yeah, zoom out for us.
VanEck's filing becomes far more than just the launch of a new, maybe niche product. It truly marks a crucial, maybe foundational step in the institutionalization of these crypto-native yield products, bringing them into the fold of traditional finance frameworks.
So it's not just about Solana access.
Not at all. It's about providing a blueprint, a meticulously crafted template, potentially, for how future staking ETFs could be structured and issued. ETFs designed explicitly to align with traditional investing norms and, critically, with regulatory expectations.
Setting a precedent.
Exactly. This precedent, if approved, could swing open the doors for other major proof-of-stake networks, think Ethereum, Cardano, others, to offer their staking yields to a much broader, regulated investor base via similar ETF structures.
And it helps that VanEck isn't exactly a newcomer throwing spaghetti at the wall here, right?
Yeah.
They have some history in this crypto ETF space.
Absolutely not a newcomer. VanEck has, by all accounts, established a pretty formidable precedent in navigating the often tricky crypto ETF landscape.
They were in the mix for the Bitcoin ETFs.
Right at the forefront. They were among the first group to successfully launch spot Bitcoin ETFs, and then they followed up with spot Ether ETFs earlier in 2024.
So they've successfully navigated the SEC process before.
Multiple times now for crypto spot products. And this history isn't just a list of past achievements on a website. It has built considerable credibility. It's fostered trust, arguably, in their approach to crypto ETF innovation. Sources like Cryptopolitan, Cointelegraph, they highlight this track record.
They know how to talk to the regulators, basically.
They've demonstrated a consistent ability to effectively engage with the SEC, to understand the evolving legal and regulatory landscape, and ultimately to bring these novel products to market successfully, often being a first mover or among the first.
And now they're leveraging that hard-won credibility.
Strategically extending it to staking-based funds. This progression, spot Bitcoin, spot Ether, now staking yield via JitoSOL, it doesn't feel accidental at all.
Looks like a plan.
It looks like a calculated, step-by-step process, showing the financial world how to responsibly integrate these new digital asset classes, not just as pure price exposure vehicles anymore.
Right. Phase 1 was spot price.
Phase 2, potentially, is integrating yield, showing how they can be legitimate, yield-generating investment products within the regulated system.
And each prior approval helps the next one.
You'd assume so. Each approval sets a precedent, incrementally building trust and clarity with regulators, essentially de-risking the next, slightly more complex crypto-native product in their pipeline.
It really is like VanEck is methodically paving the way, giving the financial world a detailed roadmap almost on how to integrate these things responsibly into mainstream portfolio.
That's a good way to put it.
And for you, the individual investor listening, this potentially means a clearer pathway for more sophisticated, regulated crypto products to eventually enter the market.
More options, potentially safer access.
It suggests a future where these innovative yield mechanisms, born out of decentralized finance, don't just stay in the degen corners. They become accessible, understandable, and compliant within your existing investment frameworks.
Which could be huge for diversification.
Potentially diversifying your income streams in ways that were previously either totally unavailable or, frankly, just far too complex and risky to manage for most people. It really signifies a major maturation, doesn't it, of the crypto investment landscape.
It feels like growing up, in a way, moving towards mainstream adoption.
Okay, but while this is undoubtedly huge news, a really significant leap forward for the industry, it's also important, I think, to frame it correctly. It's also a critical litmus test.
Yeah, that's a term that's come up a lot in the commentary.
For the whole crypto ecosystem, really. This isn't just VanEck pushing a product. It feels like it's about the SEC truly grappling, perhaps for the first time in a formal product filing context, with the nuances of proof-of-stake yield being wrapped up in a regulated ETF structure.
That's a perfect analogy, a litmus test, because it is such a novel product category, at least for the U.S. market. This JitoSOL ETF filing will rigorously test the SEC's actual openness and interpretation regarding integrating these proof-of-stake yield mechanisms inside those familiar traditional ETF shells.
We know they got comfortable with spot Bitcoin and Ether.
Eventually, yes. They acknowledge their existence, the market demand, the mechanics of the spot market. But staking introduces a whole new layer of complexity for regulators to consider.
Like what specifically?
Particularly concerning the nature of the yield itself. Where does it come from? Is it truly passive? Also, the underlying network's security model, the reliance on validators, and crucially, how potential risks like slashing are disclosed, managed, and potentially mitigated within a regulated product offered to the public.
A lot for them to chew on.
Definitely. Sources like The Street, The Defiant, CoinGate, they've all emphasized that the outcome of this specific filing, it could shape the regulatory future of staking-focused products across the entire digital asset landscape.
So the ripple effects could be huge.
Massive. The decision here won't just impact Solana or JitoSOL. It could establish a critical precedent for how staking yield is treated for other major proof-of-stake blockchains. Most notably, Ethereum, with its massive liquid staking ecosystem already in place.
Right. A yes for JitoSOL could make an Ether staking ETF seem much more plausible down the line.
Much more plausible. A no or significant delays and hurdles could chill development in that area within the regulated sphere.
And it's important to remember, these liquid staking concepts, they aren't brand new ideas VanEck just invented, are they?
Oh, not at all. These mechanisms have been battle-tested and thriving in the decentralized finance, the DeFi space, for quite a while now.
They're established crypto primitives.
Exactly. This innovation isn't emerging from a vacuum. It's really a sophisticated translation or extension of well-established, proven concepts from the DeFi ecosystem into the regulated world.
Give us some examples.
Well, other networks, and Ethereum is the absolute prime example here, have already seen incredibly robust liquid staking concepts flourish. Think about protocols like Lido Finance, Rocket Pool.
Huge players in the Ethereum space.
Massive. They utilize intricate Oracle setups, complex smart contracts to manage the whole staking process efficiently, pool assets, issue their LSTs like STETH or IF, and distribute rewards back to token holders. They've been operating at scale for years.
So what VanEck is doing is packaging that proven concept?
Essentially, yes. VanEck's strategic move takes these existing proven mechanics, the core idea of separating the yield generation from the liquidity from the decentralized world,
Yeah.
and meticulously wraps them in a package, a structure that is designed to fully comply with and fit neatly within regulated traditional finance.
Bridging the gap again.
It's about translating that crypto-native innovation, the ability to earn yield while staying liquid, into a language, and importantly, a structure that traditional institutions and their vast investor base can readily understand, trust, and ultimately participate in.
Okay, so it's not just VanEck pushing this forward in isolation then. It sounds like there's broader institutional demand here.
Oh, absolutely. There appears to be a significant and growing chorus of institutional voices essentially saying, yes, we need this now.
Who's saying that?
The source material makes it pretty clear that major players, and not just, small crypto-focused funds, but established asset managers like Bitwise and prominent venture capital firms deeply invested in the space like Multicoin Capital have already voiced their support for this JitoSOL ETF proposal.
That carries weight.
Definitely. This isn't just some niche interest from one company. It emphatically echoes what many sources call a growing industry momentum for regulated staking exposure.
Why do these institutions want it?
Well, several reasons. They recognize the inherent value proposition of staking yields, which frankly can offer a compelling alternative, or at least a diversifier, compared to historically low yields in traditional fixed income products recently.
Makes sense. Looking for yield wherever they can find it.
Exactly. Plus, they acknowledge the substantial demand they're seeing from their own client bases, high net worth individuals, family offices, even other institutions who want regulated, easy, compliant pathways into these new digital asset classes and their yield potential.
So the client demand is pulling it forward too.
Seems like it. Their vocal support lends significant weight and legitimacy to VanEck's filing. It sends a clear signal to the SEC that there's a legitimate, broad-based institutional interest. Indeed, maybe even a growing market imperative for these kinds of products.
This really raises an important question then, doesn't it, for you listening? How might the SEC's ultimate decision on this specific ETF influence the entire landscape of crypto investment products going forward?
It's a huge question. Could we be on the cusp of a significant domino effect?
Where an approval for JitoSOL just opens the floodgates, we see filings for Ethereum staking ETFs, maybe Cardano, Polkadot, others.
It's certainly possible. An approval could signal regulatory acceptance of the LST structure itself, making subsequent filings potentially easier. This truly feels like a pivotal moment.
Shaping not just this one product, but maybe the whole regulatory approach to digital asset yield generation on a much broader scale.
The implications are pretty profound, yeah. It could really accelerate the integration of crypto yields into mainstream finance.
Okay, let's shift gears slightly. Let's try and dig into some of the more fascinating data points and analytical ideas that were mentioned across the sources. Because, it's one thing to talk about these concepts abstractly.
Right, the theory is interesting.
But actually visualizing the potential impact, the dynamics, in a more concrete way, that really helps bring the whole picture home for us and for you listening.
You're right. Data, or even just visualizing trends based on data, can tell a really powerful story here.
So what kind of visualizations or comparisons help?
Well, one interesting angle is what we could call an ETF timeline comparison if we visually map out VanEck's journey.
What we discussed earlier.
Exactly. We can clearly see this compelling trajectory, almost a strategic roadmap, you could say, showing how traditional finance, led by players like VanEck, is methodically, progressively embracing digital assets.
Step by step.
Step by step. Moving from that pioneering launch of spot Bitcoin ETFs, then adding spot Ether ETFs, and now boldly progressing to this proposed JitoSOL staking ETF.
It shows intent.
Right. The sequence isn't random. It clearly visualizes a progressive, calculated strategy. They're integrating increasingly complex yet fundamentally innovative crypto-native financial products into traditional market structures.
And seeing that timeline helps you understand what?
It helps you understand the potential long-term foresight behind these moves. You see the incremental building blocks being laid, perhaps for even greater future innovation bridging TradFi and DeFi down the road.
That makes sense. What other data points are revealing?
Well, it's absolutely vital to grasp why someone might choose a staking product like this JitoSOL ETF over just buying a simple spot Solana ETF if one existed, or just holding SOL directly. And that's where analyzing staking reward versus asset price growth provides real clarity.
Oh.
When we talk about juxtaposing Solana's base SOL price movement against its potential staking yields earned via JitoSOL, we're inherently highlighting the difference in total return dynamics for an investor. It's not just about price.
Right. Total return, price change, plus yield.
Exactly. An investor just holding basic SOL sees appreciation or depreciation based only on the asset's price swings in the market, purely price exposure.
But the JitoSOL ETF holder.
An investor holding the JitoSOL ETF potentially gains both that underlying asset price movement and the accrued staking rewards, which should be reflected in the JitoSOL token's value or potentially distributed.
Can you illustrate that? Maybe a simple example.
Sure, let's try a hypothetical based on plausible conditions. Imagine over, say, a 3-month period. The price of SOL itself is pretty flat. Maybe it gains only 1% because the market's just moving sideways.
Okay. Happens all the time.
A spot SOL investor sees a pretty modest 1% return on their capital, not very exciting. But let's say JitoSOL, or the staking yield it represents, is yielding an annualized rate of, say, 4%. Pretty conservative for Solana historically, but let's use that.
Okay, 4% per year.
Over 3 months, a quarter of the year, that 4% annual yield translates to an extra 1% return just from the staking rewards, 4% divided by 4.
Ah. So you add that to the price change.
Exactly. So in our flat market scenario, the JitoSOL holder gets the 1% price gain plus the 1% yield gain for a total return of 2%. Double the return of the spot holder in this specific scenario.
That's a significant difference, especially if markets are choppy or just moving sideways.
It really highlights the potential income component. And conversely, think about a bull market. If SOL skyrockets 50%, those staking rewards, that extra percentage point or two, would further compound that growth. It potentially allows you to outperform just holding the spot asset.
So this conceptual analysis helps you visualize that compounding effect, the enhanced value proposition of an LST.
Precisely. It demonstrates how staking adds that crucial additional layer of return potential beyond just hoping the price goes up. It's a key differentiator for why someone would choose this product.
It's about capturing that extra layer of value, the yield that's sort of intrinsic to how proof-of-stake networks actually operate. That's a powerful incentive.
Definitely.
But how does JitoSOL itself, the token, compare directly to just holding regular SOL in terms of market behavior, maybe?
Yeah, that's another good comparison point, leading us to analyze staking tokens versus spot tokens.
Okay.
By conceptually displaying, maybe on a chart if we had visuals, the relative performance and maybe demand curves for JitoSOL versus basic SOL, we can illustrate the unique premium or additional utility that a liquid staking token might offer, especially when it's packaged in a regulated ETF wrapper.
Why would it behave differently?
Well, JitoSOL, by its very design, aims to track the price of SOL while simultaneously reflecting the ongoing accumulation of those staking rewards we just discussed.
So its value accrual mechanism is inherently different.
Inherently different. Over time, theory suggests JitoSOL should trade at a slight and growing premium relative to basic SOL, precisely because of that embedded yield component and the added benefit of liquidity while staking.
Does it always? Or are there market dynamics?
Market dynamics definitely play a role. Sometimes LSTs can trade slightly below peg due to liquidity demands or temporary arbitrage opportunities, but the structural design is for value accrual relative to the base asset, and demand might differ too.
How so?
Investors specifically seeking yield plus liquidity might generate unique demand for JitoSOL that's different from pure SOL price speculators. This analysis helps you understand the value proposition at an even deeper level.
Why might you choose the LST ETF over a potential future spot SOL ETF or just holding SOL?
Particularly if your primary goal is that yield generation combined with liquidity, all within a regulated, easy-to-access product. The market's demand for that specific dual-benefit liquidity and yield creates its own unique economic dynamics for JitoSOL.
And as we touched on briefly earlier, this isn't just theoretical market stuff. The market did react. instantly.
Yeah, we can't ignore that immediate signal. The market reaction snapshot serves as a powerful, real-time indicator of sentiment.
Remind us what happened.
That intraday JitoSOL price jump, roughly 6%, right after the VanEck filing announcement was picked up by news outlets like TradingView, Crypto Briefing, A-Invest.
Yeah.
It isn't just an interesting historical footnote, it's a concrete market signal. It unequivocally demonstrated immediate market confidence, or at least palpable excitement, for this type of product structure.
The market's saying, yes, please.
It suggests that investors, maybe both retail and institutional, are keenly awaiting these regulated avenues for accessing crypto yield.
Yeah.
And they clearly perceive VanEck's pioneering move as a significant, validating step in that direction.
It fundamentally validates the perceived demand.
Exactly. Validates the demand for such an offering within the broader financial ecosystem beyond just the existing DeFi users.
Okay, fantastic insights there. Now let's pivot a bit. Let's turn the focus directly to you listening for a moment.
Get the audience involved.
Exactly. Because this deep dive, ultimately, it's designed to equip you with the insights, the context, the tools you need to form your own well-informed opinions, to really grapple with what these developments mean for your own investment philosophy, your understanding of this evolving financial world.
It's about critical thinking, not just taking our word for it.
Precisely. So let's consider a few direct questions. These are inspired by some of the audience engagement hooks we saw in the source material. And look, there are no right or wrong answers here. The value is in the process of thinking them through. Okay. First one. Considering everything we've just discussed, the convenience, the regulation, the underlying tech, would you personally feel more comfortable investing in Solana staking returns via an ETF like this one? Or would you still prefer the traditional crypto route of staking directly yourself?
And maybe think about why. What factors drive that preference?
Exactly. What are the key factors for you? Is it the simplicity and regulation of the ETF? Or is it the direct control, maybe the potentially lower fees, maybe just the principle of self-custody that comes with direct staking? Think about those trade-offs.
It's a personal calculation.
Totally. Okay, next question. Do you see VanEck's pioneering move here as a definitive signal? A sign that maybe staking participation is no longer a super niche or overly risky path just for crypto experts, but potentially okay for average investors now via an ETF?
Or the flip side.
Or do you believe there are still unique, perhaps less obvious risks? Risks may be inherent to the underlying Solana blockchain technology itself, or maybe even risks specific to the structure of JitoSOL as an LST, or even the ETF wrapper. Risks that you would need to thoroughly consider before jumping in, regardless of the ETF format.
Good question. Is the wrapper enough to mitigate all underlying risks?
Something to ponder. Okay, third one, thinking about your own portfolio. If staking ETFs like this became widely available across different blockchains, and you felt comfortable with the concept, how much of your crypto allocation could these staking ETFs realistically occupy?
Are we talking a small slice, like 5%, a more significant chunk, maybe 20%, or perhaps zero if it doesn't fit your strategy?
Right. And what are the key factors that would influence your specific decision there? Is it your personal risk tolerance, your overall diversification goals, your expectations for yield versus pure price appreciation? What matters most to you?
Tailoring it to your own needs.
Exactly. And finally, let's look ahead. Crystal ball time. Which proof-of-stake network do you think might be the next one to see a filing for a staking ETF?
After Solana, who's next in line?
Could it be the big one, Ethereum with its massive existing LST market? Could it be Cardano, Polkadot, Avalanche, maybe another emerging player altogether?
And importantly, why do you think that?
Yes. What specific characteristics or recent developments make you lean towards that particular network? Are you considering factors like its market cap, its level of decentralization, maybe any existing regulatory clarity around its specific staking mechanisms, or perhaps just the current level of institutional interest you perceive in that ecosystem? What's your reasoning?
These aren't just, rhetorical questions we're throwing out there. They genuinely require some reflection.
They really do.
And considering them helps you internalize the personal implications, but also the broader market implications of everything we've discussed today. Remember, in finance, especially in crypto, there are almost always multiple valid perspectives, different strategies, different risk appetites.
What's right for one person isn't right for another.
Exactly. And engaging with these questions actively encourages that critical thinking. It pushes you beyond just passively absorbing the information we're sharing.
Forces you to weigh the pros and cons yourself.
Weigh the benefits of ease and regulation against, say, the potential for greater direct control, or against those unique, nuanced risks we mentioned. This kind of analytical engagement is precisely why understanding these developments is so crucial.
Whether you're deep in crypto already or just watching from the sidelines.
Absolutely. Whether you're a seasoned crypto investor, maybe deeply involved in DeFi already, or perhaps you're just curious about how traditional markets are adapting to this rapidly evolving digital asset landscape. It's about empowering you to be an active participant in understanding what's happening, not just a passive spectator watching the headlines fly by.
Well said. We have definitely covered an incredible amount of ground today. Hopefully, after all that, you feel much better equipped, much more confident in understanding this rapidly evolving and, I think we can agree, highly significant space at the intersection of crypto and traditional finance.
Yeah, it's a key development to watch.
We've really unpacked how VanEck JitoSOL ETF filing isn't just about Solana, is it? It represents this huge, potentially transformative step towards regulated, easy access to crypto yield.
Shaped significantly by that evolving SEC stance we discussed.
Absolutely. And serving as this crucial litmus test for the entire digital asset industry's integration with mainstream finance. Ultimately, as we said, it seems to be about making these sophisticated, yield-generating crypto opportunities potentially accessible to you in a way that feels familiar, feels regulated, feels manageable.
Bringing DeFi yields into the TradFi world, basically.
Hopefully, this deep dive has given you that clear, nuanced, and truly comprehensive understanding of what this specific development means, but also its broader implications for the future.
Fingers crossed.
Now, if you're as pumped as we are, or even just intrigued about the prospect of staking yields potentially hitting mainstream ETFs, well, here comes the important part for us. Don't forget to engage with this content.
It really does help the channel.
It helps immensely. Liking this video, subscribing to our channel if you haven't already, hitting that notification bell so you don't miss future deep dives. All of that engagement helps us out.
Likes, comments, shares.
Exactly. Whether it's just clicking like, dropping a comment below with your thoughts on those questions we asked, or maybe sharing this deep dive with a friend or colleague who'd benefit from understanding this, it really helps support the deep dive.
Boosts visibility, tells the algorithm people care.
Totally. It boosts our visibility, helps us reach more knowledge seekers like you, and frankly, it lets us keep creating the kind of quality crypto content that keeps you right at the forefront of what's happening in staking, in DeFi, and in these institutional crypto breakthroughs. We genuinely couldn't do it without your support.
So thank you in advance for that.
Absolutely. Okay, so as we wrap things up here, let's leave you with one final provocative thought. Something to mull over, keep turning your mind after you're done listening.
Food for thought.
If. And it's still an if. But if staking yield, accessed through ETFs like this, does become a widespread staple, a common component of traditional investment portfolios, what profound impact could that actually have, maybe long-term, on the underlying proof-of-stake networks themselves?
Interesting question. Impact on the tech, not just the finance.
Yeah. Think about their security, their level of decentralization, maybe even their governance models. Would this increased institutional involvement, bringing potentially billions in capital via ETFs, inherently strengthen these networks?
By bringing more capital, more professional oversight, maybe?
Perhaps. Or could it inadvertently introduce new centralization risks? What if too much stake flowing through just a handful of large ETF providers like VanEck, BlackRock, Fidelity ends up being controlled or delegated by just a few major entities?
Yeah, concentration of staking power is a known concern in POS systems.
Exactly. Does institutional adoption via ETFs help or hinder the core decentralization ethos of crypto? A really fascinating, complex question, isn't it? With potentially huge, far-reaching implications for the very future of these decentralized systems we're all watching so closely.
Definitely something to keep an eye on as the space evolves.
For sure. All right, that is all the time we have for this deep dive. Until next time, keep exploring, keep asking those critical questions, and above all, stay exceptionally well informed.